Good afternoon, everybody, and welcome to our Fireside Chat webinar. My name is Reezwana, and I'm a research analyst with the Nedbank CIB Markets Research covering SA Macro. We are joined on the webinar with my colleagues Jones Gondo, who's a senior research analyst covering credits, SOEs, ESG, among others, as well as Walter de Wet, who's a senior strategy analyst on our team covering FX, fixed income and asset allocation, amongst others. For the topic of this webinar is focusing around the budget speech, upcoming budget speech, which takes place next week, Wednesday. We have published our preview and we have a couple of slides amongst the three of us speaking about what to expect in Eskom, how this will impact the budget and markets in general. Apologies from our colleague Walter, who will have to drop off early, but we will cover his slides sufficiently, I think. Please note, questions can be posted on the chat function. We will take questions at the end of the presentation. Again, welcome and thanks, Jones. Over to you.
Thank you, Reezwana. So as you mentioned earlier that we are going into a budget where a key piece of it will be Eskom's debt solution and debt relief from the sovereign. What I'd like to start with is just to give you my conclusion of what I expect in terms of Eskom's debt solution. I expect between 70 and 80 billion worth of equity injection at this budget, and my calculations would put it that they need about that amount for every year for the next 3 years to get to about 2/3 worth of debt in terms of support, and that would essentially bolster Eskom's standalone credit rating or get it out of credit distress. And I'll go into some detail on how I get to that number, but I think the important contextual issues to remind our audience are that, first of all, that Eskom is a systemically important entity for the economy. I think that's very obvious given the extent to which load shedding has affected business activity. The second is that the sheer size and scale of Eskom compared to some of the peer SOEs make it far more important for the sovereign to have a unique solution for it. It's a very big company, a lot of people employed in it, and of course the extent to which its infrastructure needs to pivot towards a new business model is something that the sovereign as shareholder has to focus on. The third is that from a credit ratings point of view, both its scale and policy importance mean that it's important to the sovereign to give it support, extraordinary financial support, in fact, because as I'll show that as Eskom's credit has deteriorated over the years, the sovereign has had to follow suit as a consequence. And so it doesn't make sense for the sovereign to only provide partial and not full support, because it only hurts the sovereign in the end, in the final analysis. And lastly, it's really to also point out a nuance, which is really that the rating agencies now incorporate Eskom's debt into the sovereign's balance sheet because of the indications that have been given that there's an intention to take on the debt. But I think more importantly, the nuance is that the sovereign needs to manage Eskom's debt as if it were its own. And that I think is a shift change in the thinking of National Treasury, where just providing partial support to the debt is now seemingly insufficient for the problem at hand. And that means that National Treasury now has to step into the fray and manage expectations and stakeholders, ranging from rating agencies who, in any kind of debt scenario we're looking at, need to assess both the fundamental credit or credit proposition of a credit transaction, but also any particular losses that could accrue to note holders or creditors in general. Creditors themselves need to be consulted, and that's what I expect will happen after the budget. That they need to understand the terms and conditions of any kind of exchange, if any, is announced. So details are going to be important for both these stakeholders. And lastly, Eskom will welcome any type of relief. Their balance sheet is good, whether we take debt away or whether we inject equity into it. So in terms of the current situation, Eskom has been provided with ongoing balance sheet support. There's been approximately 20 billion rand per year that has been injected as equity, and that is conditional that Eskom had to achieve certain operational efficiencies. It's questionable whether that has happened, but in any case, that is the current situation. What the proposition really is that we're now looking towards either debt transfer, which can also be called the debt restructure in many ways, and the detail of how you nuance between the two is what we hope to see in the budget itself. So I want to now just dive into a little bit of where Eskom finds itself in terms of its financial standing. The colorful chart on the top right is really just its cash flow statement in the last financial set of results, financial results. And what is really clear is that its revenue is, first of all, under pressure, but that all its operating cash flows really leave very little, only 53 billion to be distributed between its debt service costs and capital expenditures. The interest payment and the debt redemptions at the end of the last financial year for them was over 70 billion rand, and versus a capex requirement of about 35 billion rand. As an anecdote, we reckon that Eskom's capex, sustaining capex, should be running well above 50 billion rand a year. So they've been cutting quite a lot in terms of capex just to allow themselves some cash relief. But you can see that the big drag for them is debt service, and that's what the sovereign has been trying to provide as a step in and support. The chart on the bottom left just shows the debt maturity profile, and it's clear that 2022 and 2023 is a real peak in its debt maturities. So that 70 billion that we saw is something that really needs attention now. They will not trade their way out of it organically. And so it means that liquidity analysis is the driver of Eskom's credit standing. And the chart on the bottom right tries to illustrate that. The way to read it is that the green bars is the difference between sources and uses of cash over history and into the forecast in line. And the green line is the ratio of those sources to uses, and you can see that on the right-hand y-axis. The story with the bars is that every time Eskom's gone into a negative cash flow cycle, a rating downgrade has ensued. And the important thing about this is where it currently sits, and at a credit rating in the CCC category, is that the best rating it can have is a B-, given the extent of its liquidity strain. And the only way out of that CCC bucket or a maximum rating of B- is if the liquidity ratio improves well above 1.5 times. It's currently sitting at just below 1 times. And what that means is the extent of bailout or financial support needs to target at least, I would imagine, a 2 times sources versus uses of cash. So if you just take a look at the forecast that I'm showing, over to 2025, the amount of cash generation is in the region of about 30 to 35 billion rand. And to double that to 2 times, the ratio at that point is 1 times. To get it to 2 times, you need about 70 billion rand, which is how I'm targeting the amount of money that they need. Obviously, if you look at the earlier years, 2023, 2024 in the forecast, they're making only a small cash surplus, and the ratio is well below 1 time, so they need a bigger amount of bailout to get there. To a target ratio of 2 times. So there's a real operating need for cash, especially if they want to do capex, and the timing of that cash can't wait for when their debt repayments happen, which is semi-annually for coupon payments in the bond market. They need the cash up front, and we can see with their diesel situation that's a real deal for them. One other aspect that I need to highlight to people is that the idea in my mind of why we need to do an unbundling of Eskom is not only just to create competitive dynamics and more efficiencies within the energy sector, but it's also quite important to understand that it's linked to how debt or cash flow generation happens within the group. The current proposition is that Eskom remains Eskom Holdings remains with the debt, but the subsidiaries that are unbundled become separate legal entities and functional entities, and that creates structural subordination. And the only way I can see for them to address this is by using upward guarantees or upstreaming guarantees to avoid it. Unfortunately, the way I see it is that given the extent of debt burden that's sitting at the holdings, the subsidiaries cannot provide that kind of guarantee without really putting themselves in a precarious situation, almost starting day one technically insolvent. And so the only way around that is to either cut the debt or pump in quite a bit of equity into the entity. And so the pace at which unbundling has been waylaid quite a bit by legislative and regulatory hurdles. But I think also that this debt transaction is a key part of this, although not much has been said in terms of details for it. The other point to make is that as we now start to consider any kind of scenarios for debt, we need to understand that it's not one homogeneous group of creditors that sit with to get to 400 billion worth of debt. A big portion of it are loans and bilateral loans with multilaterals, DFIs, export credit agencies. And then there are a number of different bonds that sit in different legal jurisdictions and under different terms and conditions. These include Euro-Rand, zero coupon bonds. They also include Euro bonds, dollar Euro bonds, and finally a guaranteed domestic medium-term note program, which are the domestic bonds. And dealing with these is not the same as you go along. In our view, the easiest to deal with are probably the zero coupon bonds, then the domestic ZAR nominal bonds, inflation-linked bonds, bilateral loans, and then lastly, the Eurobond debt piece. The important point I want to raise about these different types of debt is that National Treasury potentially has a number of hurdles and challenges that make the transaction of a debt swap or a debt exchange really difficult. The first is that the loans are project finance based, and it's very difficult under Public Finance Management Act, I would imagine, for them to take on as National Treasury the responsibilities for that. Whether it's a legal uncertainty to even have ring-fenced money or exposures on the sovereign balance sheet is a question mark. The second is that there are a number of cross-currency swaps attached to those loans, which need to be novated into the sovereign's name. And to break those swaps opens up the sovereign or exposes them to a potential ISDA or CSA clause or breakage, which can be construed as an event of default if it's not managed in the right way, because losses can accrue, which leaves them with a big portion of the debt, over 130 billion rands worth, that is challenging to move. The second portion of the debt to think about are the bonds, the domestic bonds. And what you're looking at now is a chart of South Africa's government bond maturity profile overlaid with Eskom's bond maturity profile. And in an instance where the sovereign wants to take that on, there are, again, a number of hurdles. The first is they have three options of how to do this. Either they would do it as a cash tender offer, which is basically the holders of Eskom bonds can tender their bonds to National Treasury for cash, which would imply that the there's a drawdown of National Treasury's cash balances to pay this. The second would be trying to switch into a duration neutral position, which is essentially looking at the effective maturity buckets that Eskom is in, and you exchange it into equivalent maturity or duration notes on the South African government bond curve, so existing notes. But ultimately, rating agencies just want to know that whatever ratio of exchange that you use, you come out NPV neutral, which is essentially saying that you're made whole at every point. And the valuation of a near-term maturing bond that's currently trading at a premium to par versus at Eskom versus a longer tenor bond, which is at a deep discount to par, that creates challenges in terms of figuring out what the overall valuation would be. And this kind of complication affects different pools of creditors and what they're willing to accept. Some are willing not to participate and hold to maturity instead. And so this is why it's very important that if they pursue a proposal of this nature, that National Treasury does engage note holders and gauge their appetite to do any such transaction. One other thing to mention is that we think that adding supply where the whole bond curve that is in government bonds is not a participant, only those that hold Eskom bonds would be a natural participant in getting these new SA government bond notes, means that there are liquidity issues that affect the pricing of the curve in the secondary market. And so it only makes sense to me to try and issue new issue points for at least for the nominal bonds, at least two, to give the market a sense of appetite. It might be towards the belly of the bond or the long belly of the curve or the long end of the curve. And there will need to be an issuance as well of inflation-linked notes, which typically on a weekly basis don't have strong liquidity showing for or appetite in any case. So price discovery will be an issue. It's a similar story for the dollar curve, for the South African dollar curve. And the only thing to mention here is that the size of Eskom bonds relative to the outstandings of South African dollar bonds is almost the same at each tenor bucket up until 2030. So to try and term these out or put it elsewhere on the sovereign's curve as new issue points, first of all, would need to be around about 2 billion a piece, or 1.5 billion a piece, just to give it context. South Africa rarely issues above 2 to 2.5 billion. And also you'll find that it's probably cheaper to just redeem these notes as they become due. And the final slide I want to show, Reez, is just that the fact that when you look at yields of Eskom versus the sovereign curve itself. The difference in those yields tell you where there's going to be an expensive transaction or a cheap one. And of course, for the South African government bonds in the ZAR market, these are guaranteed, and so there's a lesser of a spread between the sovereign and Eskom across the curve, but it's far more pronounced where Eskom has printed unguaranteed notes in the Eurobond market and a couple of guaranteed notes. And so the cost benefit at the end in our analysis is, for all this complexity and what it's worth, for the sake of Eskom needing the debt relief, it's far simpler to inject equity and allow Eskom to engage the market voluntarily once its credit position has moved out of distress, to avoid a distressed exchange and do it over time. I'll hand over to you, Reese, to see what it means for our budget.
Thanks so much, John. So it's quite clear in terms of Eskom that a debt transfer from Eskom to the government is going to be quite complex, perhaps more expensive, and that we're likely to see an equity injection instead of a debt swap over the next couple of years. Then the next question is how do we pay for this from a fiscal standpoint? So I guess if we can move over onto the next slide. We have published our preview in terms of the budget, our key forecast, headline forecast, which takes into account growth, inflation, our outlook for revenue and spending. And obviously, this all culminates into a budget deficit and a debt profile over the medium term. Jones, there's a bit of a patch in the middle of the presentation. Is there a pop-up on your screen? There we go. Thanks so much. In terms of our growth profile, so we're projecting growth of about 1.3% per annum over the next 3 years. And we've got inflation that is slightly higher in the current fiscal year, which is 2022-23, remains elevated in 2023, and then falls to about 4.5% in the outer 2 years. Because of those relatively elevated figures for both inflation and real GDP growth, we've got a nominal GDP forecast that is higher than what National Treasury had at the time of the MTBPS. What that does is it does inflate our nominal GDP by a bit more than the MTBPS forecast. And over the next 4 years, that does mean that revenue growth, which is essentially derived from nominal GDP growth, revenue growth remains robust. From a revenue perspective, we do think that the October MTBPS revenue profile looks fair. Our estimates point to a slight overshoot in terms of revenue collection, but that is mostly as a result of high inflation rather than any real gains in terms of revenue. A key question that we get from clients is how realistic is our growth assumption, especially given what the SARB has done last month with its own growth profile. So we do believe that there is downside risk to the growth forecast projected here. But having said that, even if we take growth to between 0 and 0.5% over the next 3 years, so 0.5 percentage point over the next 3 years, that does not really impact revenue growth in the first 2 years of the forecast period. It really impacts revenue negatively in 2024 and 2025. So for now, in the near term, we think from a fiscal perspective, the budget actually looks fair, looks manageable. Even on the upcoming slides, you look at the ratios, even taking into account a bigger SOE bailout or an Eskom bailout. We think for now, National Treasury is able to afford this bailout. However, our big concern comes through as we head into 2024 and into 2025, when there are quite a big downside risks to revenue. In terms of looking at fiscal thrust, so essentially looking at how expansionary or contractionary fiscal policy is in general. You can see in the COVID years, fiscal policy was in contractionary phase, and then moving to expansionary phase over the years 2021 and 2022, being driven by those tax revenue overshoots coming through from finance, mining, and manufacturing industries. Over the next 3 years, it's likely to fall or become less expansionary because of slower revenue growth, as well as slower expenditure growth that the MTBPS has. Moving over to the next slide, we talk about some of these spending pressures. So I outlined why we think the revenue profile is fair and there's more downside risks in the 2024 and 2025 years, purely as a result of downside risk to growth. From an expenditure perspective, we think that there are much bigger and more immediate risks to the fiscus from a spending standpoint. The line chart on the left-hand side just takes a look at year-on-year growth in spending across departments, provinces, local government, etc., and election years highlighted there. What we clearly see is that there has been a downtrend in spending or spending growth, but what we see in terms of the October MTBPS forecast is that spending growth is quite unrealistic. For example, the table just summarizes the line chart there. If you look at national departments, historically in the year of an election, spending there has grown by about 25%. The year before an election, spending on national departments have typically increased by about 12%. Over the next 3 years, National Treasury is projecting no growth in spending on national departments. And what we do know is obviously the year before an election, we see a substantial increase in expenditure within departments itself. So we do think that there are risks that this gets revised up in the budget, along with spending in terms of provincial, local government, as well as total spending. Jones had outlined our expectations for Eskom, or rather the bailout likely to be provided to Eskom. But what we take into account in our own budget forecast is, or projected budget, is we account for about 90 billions per annum rather being provided to all SOEs. 70 billion likely to be given to Eskom and 20 billion to all other SOEs. And we think that that spending on SOEs is much more realistic than what National Treasury has currently, which is about 22 billion per annum over the next years purely for Eskom. In terms of the wage bill, that has been another point of contention over the past year. The line chart essentially is the year-on-year growth rate in the wage bill. Historically, you can see that even here there's been a clear downtrend. But what we see in terms of the October forecast is that wage bill growth is still too low. For example, this year, National Treasury is forecasting just a 1% growth in the wage bill. We know that the current wage agreement has increased the wage bill by more than 6%, and so to assume a 1% growth in the current year, when the wage bill has typically grown well above this level, is unrealistic in our view. What we have also noticed in terms of the wage bill is that it has been revised up in February last year, it has been revised up in October last year, and it's likely to be revised up next week as well at the budget speech. Our own forecast of the wage bill, we increase our own projected wage bill by 6.6% per annum over the next 3 years, assuming the current wage agreement gets rolled over the next 3 years. That adds about 229 billion rands to spending over a 3-year period. And we think that eventually that will be the realistic outcome with regards to the wage bill, as opposed to the current projections, which are too low in our view. And then I guess maybe lastly, coming to our ratio slide, if you look at our debt to GDP ratio on the left-hand side, brown line indicating a fairly flat profile. We've got a forecast of the debt to GDP ratio rising to about 71% from the current 70%. and that takes into account an equity injection to Eskom. Alternatively, if National Treasury were not to provide an equity injection but rather do a debt swap, assuming that full 210 billion rand debt swap in Eskom's debt upfront, that will increase the debt to GDP ratio to about 74%, and that's highlighted in the dotted line there. Um, if you look at the deficit, our projected deficit rises to about 4.9% of GDP from 4.3% in the current year. It is well above October MTBPS forecasts, and our projected deficit takes into account all of the spending pressures mentioned above, higher wage bill, bigger bailouts to SOEs, as well as a permanent basic income grant carried forward over the next 3 years. Having said that, if you look at optically both ratios, they look fairly manageable. And if we cast our minds back to pre-COVID or during COVID, the projections for both the debt to GDP ratio and the deficit were substantially above where we are currently. And the main reason for much more grounded ratios now is because our nominal GDP has grown quite substantially in the last 2 years, alongside high and big rather revenue bailouts that we have experienced during the last 2 years. So our high and inflated nominal GDP baseline and then forecast results in our ratios remaining quite flat over the forecast period. How do we pay for all of this? This table is just taking a look at 2023-2024, so the new fiscal year, which starts in April this year. We start with the bottom line, which is the budget deficit forecast. Our forecast is highlighted in yellow there. You can see that we are projecting a much bigger budget deficit than National Treasury's forecast as at the October MTBPS. We work our way upwards, and this is how the government essentially pays for the deficit. We add redemptions, upcoming redemptions, debt that falls due in the upcoming year, to get a financing requirement that is just over 500 billion rands. And they can finance this using a mixture of cash, foreign loans, T-bills, short-term loans, nominal bond issuance, ILB issuance, floating rate note issuance, various sources of debt financing. What I haven't shown in the presentation is government's cash balances, which are currently quite elevated. Government is sitting on about 360 billion rands worth of cash. It's close to historic highs, and it is above where National Treasury projected to collect cash. So they've essentially collected more cash than they were budgeting for. What we believe will happen at this budget is that National Treasury is unlikely to increase weekly issuance in terms of nominal bonds and ILBs, but it will likely do more floating rate note issuance and use much more cash. So even though in our breakdown we've kept our cash usage unchanged at 85 billion, we do think that National Treasury is likely to use rather more 40 billion rand more than what they currently project there. Alternatively, if they don't use more cash to be able to afford this bigger budget deficit, they will need to increase nominal issuance in our view to about 4.8 billion per week from the current pace of about 3.9 billion. The government's debt redemption profile is on the right-hand side here, and you see fairly large debt falling due over the next 12 months that the government obviously needs that cash on hand for to be able to pay down that debt. A reminder, please place your questions in the chat and we'll get to it. We're coming to it towards the end of our presentation. We just have sort of a last couple of slides on the view for the bond market. In terms of our view for 10-year bond yields, we do think that SA bonds in general, government bonds, offer quite a bit of value, particularly in the around the belly of the curve, the short end to the belly of the curve. In terms of our fair value for the 10-year, our fair value is currently at 10.2%. It has been lowered mainly on the back of lower US real yields, so a decline in US real yields over the last 6 months or so. What we are interested though is how will bonds or fair value in terms of bond yields be impacted if we are wrong on the budget and if we see significant changes away from our forecast. The bar chart on the left hand side just takes a look at various sensitivities. So if we, for example, if we were to get a debt to GDP ratio that is 10% above where we currently project, so we currently have a debt to GDP ratio that is around 71%. If we were to see the debt to GDP ratio increasing to above 80%, then we believe yields in the 10-year space should be between 90 and 100 basis points higher. Similarly, if you look at a budget deficit, if the budget deficit is materially above our 4.9% forecast, then that will increase the yield slightly by about 12 basis points. But the biggest movers or sensitivities to in terms of our local bond yields are coming through from local monetary policy as well as what happens in the US in terms of their own monetary policy, which culminates in changes in the US 10-year yield. So essentially for every 100 basis points change, increase in the US 10-year bond yield, we are likely to see our own bond yield increase by about 200 basis points. Similarly, if you look at local inflation, sharply higher local headline CPI will increase yields proportionately. From a curve perspective, monetary policy and inflation have a bigger impact on shorter term bonds. Whereas if you look at longer term bonds, it's quite dependent on the offshore funding requirement along with fiscal policy dynamics, essentially what happens to the debt stock of the country. Overall, if you look at our fair value for the whole curve, so the black dots is our own fair value. The light green dots is essentially the yield curve as at 18 Jan. We do believe that there is some downside for bond yields, so upside for bonds in general, because of, as I've indicated, slightly lower US real yields, but essentially a budget that is priced by the market currently, so we don't expect significant surprises there at the upcoming budget next week. However, in terms of from a total return or expected return perspective, measuring return as a as a function of modified duration, the return profile is quite flat, and we do favor sort of the belly of the curve because we don't think that the long end provides significant upside from a return perspective for the amount of duration risk that you assume in terms of the long end bonds. But for now, from an asset class perspective, we can just skip over to the last slide. From an asset class perspective, we do think that bonds will likely over the next 6 to 12 months provide the greatest upside, followed by cash, listed property, and fairly neutral to downside bias with regards to equity and corporate credit. We have come to the end of our presentation. Again, a reminder, we'll give you a few more seconds to provide your questions on the chat, type your questions on the chat. Alternatively, you can always reach out to either Jones, Walter, or myself if you do have questions after today's presentation, and we will be happy to respond to you directly. Are there any questions on the chat? Okay, we don't see any questions on the chat. Jones, do you have any other thoughts to share, or do we wait?
I think I'll just re-emphasize the conclusion is to say that even in our scenario of even larger bailouts, a lot of the feedback we've heard from clients is just, is this going to help change anything at Eskom given the operational challenges? I think it's the short answer is no. I think it's all priced in, especially into our bonds from what you presented. And the reality is that for us to sort of fill the gap on operational on production of electricity, that has to come from the renewable programs, and I think that's where we need to see significant moves over the short to medium term. Of course, there's a lot of fluidity in the policy environment at the moment in terms of, now we have a new Minister of Electricity that will help sort of move things along. There's a lot that needs to be seen, and that uncertainty is one of the reasons why we think going long duration is not a particular strategy. And I think the point also to emphasize is that even if we're wrong and they do decide to go and do a debt swap plan, it is possible to do it. But I think the market will then price accordingly, and I think our sensitivities put it across quite well. If all the debt happened to go onto the balance sheet, that'll only be an additional, call it 4% of GDP. So from 70 to 74% debt to GDP. And so we would imagine our fair value going from 10.2 to 10.6, all things being equal. And I think that eventuality would be priced into the curve. But I do think that it's a very difficult thing or a difficult cost to appreciate until we have more detail in the budget.
Thanks, Jones. I guess I'd like to conclude from a budget perspective as well that we don't expect any sort of material shocks in the budget. We're not expecting any material tax changes or announcements. President has indicated in the SONA that there are likely to be tax breaks, tax credits being considered for households and businesses investing in renewables. So that will be pretty much a positive takeaway from the budget. But from a bottom lines perspective, from a deficit, from a debt management perspective, we're not expecting material slippage for now, even after we include a lot of the big expenditure pressures that have been talked about for much of the 12 months. We look forward to updating you immediately after the budget. And like I said, if you do have any questions that we haven't addressed in today's webinar, haven't been more clear about, please feel free to reach out to us. And thank you so much for joining us on today's Fireside Chat. Take care and have a good afternoon.